Over the past few weeks, there's been a great deal of confusion with respect to the U.S.-Chinese trade policy. Basically, on the evening of July 31st, just after the Federal Reserve cut interest rates by 25 basis points, citing the Chinese-U.S. trade war 16 times in the post-meeting press conference, the administration decided to implement two changes to U.S. tariff policies. First, they were going to take the 10% tariff on $200 billion worth of Chinese goods that's been in effect now for the past 15 months and raise that to 25%. Secondly, they were going to create a separate 10% tariff on an additional $300 billion worth of Chinese goods coming into the U.S. So the announcement of these policies, which were meant to take effect on September 1st, created a great deal of upset in financial markets. First, the Chinese allowed their currency to decline by a few percent versus the US dollar, which sent shockwaves through global commodity markets as well as other currency markets, and also helped to create a sell-off in the US equity market and a steep decline in US bond yields that further inverted the yield curve. As such, on Tuesday, August 13th, the administration backtracked partly, but this backtracking was somewhat confused by the market. The administration basically said that part of that additional 10% tariff on the $300 billion worth of goods that haven't been previously subject to tariffs would be delayed until December 15th. But maybe not the entire thing, just portions of it related to popular consumer goods. It could be big retail sales items going into the Christmas season, including toys, iPhones, and other products. But that the tariff would still be coming into effect after most of the Christmas buying has been done on December 15th of this year. So when this announcement was made, this was greeted by a sigh of relief across risky asset markets. The S&P 500 and the NASDAQ rose 2% on that Tuesday, but then the following day, on Wednesday the 14th, the market fell back 3%, realizing that in fact, not that much had changed. Basically, this 10% tax on $200 billion worth of goods, which is a $20 billion tax, still becomes a $50 billion tax on September 1, which is already a pretty substantial change. And the remaining 10% times $300 billion, or the remaining $30 billion tax, will still be coming into effect entirely by December 15th, and maybe partly before that on September 1st, at least with respect to certain goods. So U.S. administration's trade policy towards China seems to be evolving on a very rapid basis, something to keep track of for the rest of the summer, as it's having an impact on a tremendous range of different markets. I'm Eric Norland, Senior Economist with the CME Group in London.